Hello, everyone. My name is Jared Jones. I'm seeing that everybody's coming in right now, so we'll give it a second, let some more people if they're getting home from work. All right, let's get started. So my name is Jared Jones. I am the Director of Investments and a lead advisor here at Omega Wealth Management. Today we're going to be talking about everybody's favorite subject, the market and elections coming up. So we'll have Kathy Frakes with us. She's behind the scenes. She's going to be moderating, looking for any questions. So if you see the questions tab, you should be able to ask questions. And we have a slide at the end. We'll try and get to all of your questions at the end of the presentation. So we'll look to do that. So other than that, let's go ahead and dive in. Oh, one other thing, we are back in the office at Omega. So what you see behind me is not a Zoom background. We're actually back in the office. At least some of the team members are. We started coming back after Labor Day. We're in our individual offices doing social distancing, and we all have masks. So that's been a good development for most of us. But let's go ahead and dive into the show. So here's where we're going to start. 2020 has been a year of stress for everyone, whether it's social unrest, coronavirus, the market's declining. There's no doubt that this has been one of the worst years for everyone's stress. I know I personally have been stressed a lot lately. So for this presentation, we're going to be focusing on putting elections in the perspective of history and how they impact the markets. We're not going to be talking about politics. We're not going to be giving you our take on Republicans versus Democrats. We're going to be sticking to just the facts. And that might feel a little over rational right now. And there's a lot of yeah, buts. What about all of this going on in 2020? We're going to focus on, putting this in a historical context for everyone. So hopefully you come away with some more knowledge and you might feel more informed. And I know for at least me, I'm a rational, I guess, typical guy mind, a lot of facts going on. I like that stuff. So when I see and read stuff like that's in this presentation, it gives me a sense of calm, and hopefully that can happen for you guys too. So let's all take a collective deep breath as we begin to talk about some politics and the markets. And let's dive into what has happened so far this year. So as we all know, it's been an incredible ride in the markets, to say at least. The fastest bull market and fastest bear market back to back. So 2020 has been quite the year. From January to the end of March, the market was down 34%. Then from March to about, just around last week or a little bit after last week, we were up, I think, 60%. And then over the last week and a half or so, we've seen a 10% correction in the markets. And that leads to quite the timeline. So you can see from the slides here, the bear market took just 22 days of trading. And to put that into context, that's at the Great Depression level. We hadn't seen those numbers since 1928, 29, or early in the 20s. And then all throughout the 30s, the market was doing this kind of stuff. So we hadn't really seen, I remember we did a presentation, Lisa and I, back in, I think, the last week of March, right as the market was bottoming. And a lot of the comparisons that we threw out were Great Depression numbers, which made everybody feel great. It's always a good sign, I think, when you're comparing current market activity to Great Depression levels. So not a great time, but we've seen a massive recovery in the stock market since then. And now we're seeing a little bit more volatility come back. There's speculation, could this be the start of something bigger, or is this a healthy correction that comes with every bounce back from a dramatic dip like we saw earlier in the year? So a little bit of what is going on in the markets by the numbers. It's really been a tale of two markets. We've seen the S&P. These are return numbers on the left-hand side as of yesterday. So if I was actually building this PowerPoint last week, and the numbers have gone down quite a bit. I think last week when I looked, the S&P was up 4%, but now it's back down to just over 1.5% up on the year. But as we look into it, there's been a drastic divide between growth and value. We've seen growth stocks propel the markets where value has been lagging. And it's even greater exaggerated as you look at large cap versus small cap, and particularly large cap growth versus small cap value. So those have been the two you can see there. It's a very polarized look at the markets. Large cap growth, that's the FANG stocks. So Facebook, Amazon, Apple, Netflix, Google. A lot of the companies that haven't been impacted by social distancing, we've seen their profits remain high. They don't need to be in person, so their stock has done better, whereas the smaller companies have not. So I took a look just before this presentation at what the Russell 2000 equal weight ETF has returned year to date, and it's down 13.38%. So equal weight is a traditional S&P is a market cap, and so it looks at what the stock price is multiplied by the shares outstanding. So the larger companies take up more of the stock price. And that's happened with Google, Apple, Amazon. As their share prices have risen, they've done stock splits. They've seen their share of the index increase over time. I think now the 5 biggest companies make up something like half of the NASDAQ index, which the NASDAQ has had a record year. It's well above where the top has been in history. So that's pretty interesting. So as we look across the market, there isn't this story that we're positive on the year. If we look equally across the Russell 2000, which makes up something like 85% of the US stock market, we see that the market is down. So it's just a matter of what you're looking at. A lot of people have said it doesn't quite make sense that the stock market is positive when everything looks terrible. And we think that's true as well. So as we look at some of the economic numbers here, we've seen the Q2 GDP, and I really hate how they do GDP numbers. They quote them annualized. So when we saw Q2 GDP come out being down 33%, it made me pause and be like, did GDP really decline 33%? It's an annualized number. So that's saying if Q2 happened every quarter, basically, then we would be 33% down on GDP for the year. So that's what that means. We've also seen a massive decline in employment numbers. You can see by that graph, and then a slight bounce back. We're still, as of September 4th, down 8.4%. The unemployment rate is 8.4%. So while the economy is in shatters, that doesn't always correlate to the stock market being negative. I know we talked about on the last slide, as we look at the broader market, it's not quite as rosy as it looks in the S&P or the Dow, but the news media has been saying that the stock market is positive. And this quote, it gets tossed around a lot. One of my professors in college always used to say it, the stock market is not the economy and the economy isn't the market. And I think if you're a marketplace fan on NPR with Kai Ryssdal, he throws that quote out, and it's true as well. So while the market and the economy aren't the same, they're definitely correlated. And there are a couple of reasons why we think the stock market would do well if the economy isn't doing poor as well. So we've seen monetary and fiscal policy be at the greatest levels. So the greatest increase in dollars circulating since World War II. So there's been a massive push there by the government to say, hey, we're going to back companies. We're going to keep people having income. We saw the increase in unemployment checks that stopped recently, the $600 extra a month. That was very helpful for people. So the other reason besides monetary and fiscal policy is investors. As investors, we have the ability to look out ahead. I remember back in March, everyone was saying, oh, this will be a V recovery. Once things go away, coronavirus will last maybe until summertime, and then everybody's going to come roaring back. So investors have this ability to look ahead, where maybe the economy, we see the economic numbers and those are looking backwards, right? So the Q2 GDP numbers come out well after Q2 is over, and then they're revised and revised again. But as investors, we look ahead. So a number, like I said earlier, with the large cap, the mega cap, these huge tech companies, they have been increasing in market cap size, which have pulled the S&P and the Dow up, and their corporate bottom lines haven't really been impacted all that much by coronavirus. So that's another reason. So it's clear that the market, or the economy, excuse me, is not doing very well. So we look back to see this is our first historical nugget. Looking back over the past 100 years, or across all presidents, no president has been reelected within the 2 years before reelection. So 2 years before their reelection, no president has been reelected when the economy is at a downturn. It hasn't happened since William McKinley, I believe, and that was in the 1900s. So history is not on the income. Oh, skip too far ahead. Sorry. History is not on the side of the president who's in office while the economy is doing bad and you're up for election. So first history nugget of the day. All right. So just a quick market outlook for us at Omega. And we kind of break it in between the positives and the negatives right now. So the positive is the U.S. has been the cleanest shirt in the global laundry hamper for years. That's a tag that you get seen thrown around a lot in financial media. So the U.S. stock market is also dominated by the best and brightest companies, you know, the Facebooks, the Amazons. These are kind of the best companies in the world right now. And as you look internationally, there aren't a lot of companies like that elsewhere. So even in the face of the global pandemic, we think the U.S. economy is going to find a way to pull through it. The country and the world are figuring out how to operate. One interesting development that I've noticed is weddings are starting to happen again. A lot of my friends were supposed to get married this year, that they punted. I think that's an illustration of, as a country, as a globe, we're going to figure out how to live in our new normal. On the negative side, looking at the market, there is a large concentration of companies doing well that are making things in the market look better. We've already talked about the FANG stocks. So that concentration risk is what that's called. So there's a large concentration of companies, there's a small concentration of companies that are pulling the market along. That goes both ways. If anything were to happen where those companies wouldn't be doing well, they can pull the market down equally as fast as we've seen it rise over the last 6 months or so. And then countless small businesses are closed forever. We've seen, I think, 75,000 small businesses closed is one of the statistics I saw. It's probably different from then, but a couple months ago or a couple weeks ago, I saw that, and it was pretty eye-opening that real businesses are failing through this. People are losing their livelihoods. And then what happens when the relief runs out? We've already started to see that with the unemployment kind of going away. What happens as we move through the fall? We've seen the airlines talk about layoffs coming up. So that leads to a negative outlook. And then on top of all that, there's the 2020 election. And we've been getting a lot of questions from clients about, you know, what can we expect with the election coming up? What is the market going to do? So that's what we're going to focus on next. So we're going to look back at markets and elections and a look back through history. But before we do that, I just want to pull up this slide. And this really illustrates kind of where we are as a country right now, unfortunately. We see a growing divide. This is an interesting graph pulled from JP Morgan and Pew Research. They put this together. So basically ahead of the downturn, this graph is showing your market, how you feel about the economy, whether you'd rate it as great or good based on your political leanings. So ahead of the downturn, we could see the widest divide between Republicans and Democrats really going back to 2000. And I think that is a perfect point that we bring our own biases. So a lot of people, if we talk to Republicans or talk to Democrats, or if we turn on the news on a certain channel, we're going to get a different take on what's going on in the economy, depending on what we're looking at. And I think we bring that, it's hard not to, as individuals, to bring that to any rational conversation or to look at what's going on in the markets and the economy as a whole. So I think that's worth pointing out before we jump in further. So this next slide is looking at annualized returns during presidential terms. So going back to 1929 with Hoover, we can see what returns look like. And what I gathered from this chart is there's really no good conclusion to be drawn here. It's hard to say that with this person being in power, the market does X. It's really hard to say just because a certain person is in power. As humans, we want to be able to say this person is going to control the markets. They're going to push through all this legislation, and the market's going to react this way. We just want to simplify things, make it like a linear process across, but in reality, there are infinite number of forces out there impacting the market. So for example, coronavirus right now probably has a larger impact on what we're seeing in the market than the election coming up, in my opinion. If you look at the polls, they really haven't moved all that much in the last 3 months. Whereas, we've seen an uptick in coronavirus cases, and of course, we've seen the market pull back, and they're probably related in some way. So there are a number of, that's a long way of saying there are a number of factors other than just who's sitting in the White House that impact returns. And we've seen this with Obama. A lot of people thought that he would push through some, what was called at the time, socialist agenda, and the markets were tank. You can see from this graph, we didn't see that. Same with Trump, even on election night when it became clear he was going to win. I believe the futures market we saw hit limit down, which is when the futures markets close. They've seen a big dip, and they actually hit a circuit breaker and they close. And then the next day, I think we ended up being positive on the day. So we see this all the time where investors make this story about what will happen, and then in reality it doesn't. So I think that's interesting to hold on to as we look at this election coming up. Next, we wanted to look at returns during the election year, so leading up to the election and then the subsequent year. So investors have a history, and we just talked about it, of overplaying the importance of elections and market cycles. So in the year leading up to elections, we have seen more muted performance. We looked at on average over the last 9 years, given any 12-month period, we saw a return of 8.5% return. And in the year leading up to the election, we see a much more muted return. On average, it's about 6%. So I thought that was interesting. Bonds also have a similar storyline where in a given year, they usually see 7.5% return over the last 90 years. And then in the year leading up to an election, they see about 6% on average. In the year after an election, stock markets also tend to be slightly lower the following year. Bonds, on the other hand, tend to outperform a little. So it doesn't make much difference which party is in office, but it does matter which party is in control, or I'm sorry, it does matter if a party changes hands in the White House. So we see when a new party comes into power, market gains average about 5%, we saw. So, and when the same president is reelected, if one party regains control, so a new party coming in, it's slightly higher at 6.5%. So I found that to be interesting. And I should say also that we're going to make these slides available to everyone, so you'll be able to dig into these numbers on your own after the presentation. So the takeaway as we look at markets and elections, this is a great graph. It just shows that, as a long-term investor, should we really care about who's in office? And the answer, I think, is no. If you're confident about the future of the United States, which I know is kind of up in the air right now, if you're confident about the long-term success of the United States, you would believe that no matter who's in office, the market will continue to rise slowly over time. And that's shown here by this graph. Depending on who's in power, the market has gone up. And conversely, during presidencies, we also see that no matter who is in office, going back to Herbert Hoover, again, in 1929, every president since then has seen their own problem pop up. So a double-digit drawdown has happened in every presidency, which I found pretty startling. So going back to Herbert Hoover, we see that currently Trump's biggest drawdown was 31 or 34%, through March 23rd. And if you asked, will this continue on? That's pure speculation at this point. I think it's hard to say what would happen, who's elected next. The other thing we looked at was, does it matter? There's also some talk out there about, does it matter if the president is in one party versus Congress controlling, or Congress being another party? So we looked at that. We pulled this from Bank of America and Merrill Lynch. And you can see it breaks down what the average annualized performance was in the S&P when the president and then Congress below it. So you can see Republican, 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 Democrat. So obviously from this graph, a Republican president and a Republican Congress has done the worst historically, where a Democratic president and a split Congress has done better. So that's interesting to take away. And you can see, so there's kind of a correlation between gridlock. We see, unfortunately, gridlock is not the best for the nation, but the market does like predictability. Predictability of nothing getting done is easier to wrap your head around. So the market tends to like gridlock, unfortunately. So with less than 40, I think we're right at 40-day mark. It might be less than that now, but with the election coming up, it's looking like we might, it's possible that we see a Democratic sweep. And we wanted to think about if that was concerning or not. So we looked back. This was pulled from a firm, another planning firm that does great research. So we looked back over the past, back to 1951 to Harry Truman, when the Democrats control the White House and Congress. These are the returns we saw in those years. So there's only been a negative in 3 of those years, with the average return being 13.2%. Through those years. So history doesn't give us any guidance on if the Democrats are able to get the Senate, the presidency, and keep the House. There's no historical precedent for it being a bad for the markets. We also wanted to look a little bit at volatility leading up to the market. So you would think that as we get closer to the election, volatility tends to pick up. But over the last 40 years of market history, we've seen a lowering in volatility in the 100 days leading up to the election. And this happened both in 2012 and 2016. We saw lower volatility. You'd have to look back. So this year has obviously been crazy. You'd have to look back to 1968 to see similar levels of social unrest and a pandemic, a global pandemic, albeit the 1968 flu pandemic. I don't think that held any weight compared to what we're going through right now, but looking for something out there that's similar. That year saw the S&P gain 3% in the 100 days leading up to the election, and that was already adding on to year-to-date gains at that point. So that's a similar year where the economy and the nation as a whole is going through a lot of social unrest, yet the market is giving positive returns. So if there is to be an uptick in volatility, we don't think that, and we're seeing that now, if there is to be more of an uptick in volatility, we don't think it's going to necessarily be because of the election. It will be because of a number of other factors. Obviously, the biggest of which is the coronavirus and how companies and the economy are reacting to that. Obviously, if there's an uptick in cases like we're starting to perhaps see, the markets will get more rocky. We do anticipate volatility either way, no matter what happens with the election, whatever develops. Just with the year that 2020 we're in, we're expecting to see some volatility. But historically, and volatility in elections, we found that to be interesting. The 100 days leading up, you would think it would be less, actually, or excuse me, you would think it would be more, it's actually less. All right, so we also wanted to talk, there's been a lot of talk about the tax changes perhaps coming if Biden is elected the president and the Democrats are able to get the Senate as well and push through some legislation. Basically what we're seeing with Biden. So Trump is easy. Trump's going to keep everything basically the same where it is today. Biden is proposing raising the top bracket back to where it was before the Tax Cut and Jobs Act, back to the 39.6% bracket. The big change that we're seeing being proposed is the talk around capital gains tax being eliminated, and that would be tied to your tax bracket. This isn't the first time in history that we've seen that. Obviously, with that being proposed, there would be some planning that would need to go into thinking about if we needed to sell anything off your portfolio for cash needs, if we might get a better tax rate now before capital gains the capital gains rate gets eliminated. But right now, it feels a little early on to be having that conversation. If you think back to when Trump pushed through the recent Tax Act, it didn't happen right away. There's a lot of dominoes that need to fall into place to where legislation actually gets push through. So this is something that we're absolutely paying attention to, and a lot of planning will need to happen before that goes in. We're hoping we get some guidance and then a lot of lead time before it actually happens. So that's the biggest change, I think, between the two presidential candidates. As we look at the itemized deductions, so with the raising of rates, Biden would reinstate a lot of the limitations around deductions. There would be no limit on your state and local taxes, where we're capped at $10,000 right now. So a lot of people would be happy about that. I know living in this area, there's a lot of local taxes. And if you live in Maryland, state taxes, or even DC, state taxes are a lot higher than in Virginia. So a lot of people might be happy about that. So that's just to say, just because the tax rate is going to go up, it's going to be a case-by-case basis on what happens to your end-of-year tax picture. It's not as easy as saying you're going to pay more in taxes. You might be getting more deductions. You might pay a higher rate. It's really no cookie-cutter advice out there right now. So the alternative minimum tax, that's a less common thing we talk about with clients, but Biden would return it to normal, and then Trump would keep it as is right now. So the other big thing that's not included on these slides is corporate tax rates. A lot of talk has been out there about that. Biden is proposing raising corporate taxes up to 28%, which would be less than where they were under Obama. And then, of course, Trump is proposing keeping them at 21%. And there's been a lot of talk, about, are the markets pricing in a Biden presidency? And, I would say that we've seen this for a long time. The Biden versus Trump polls have been out really since, springtime. And we've seen them not move very much. And I know that was the case back in 2016. So there's not a lot you can take away from polls, but I guarantee you the market is thinking about a Biden presidency. And to wrap things up, what do we make of all this? So we believe that regardless who wins in November, many of the same problems facing us right now with the economy coming back, coronavirus, a lot of those problems are going to persist for a time, no matter who the president is. There is no magic wand out there. Historically at least, the best returns in the market that we see come from a split in power between Congress and the president. Markets like predictability. They like the idea of gridlock. I'm not sure that serves the nation the best, but at least the market likes it. I'll be that, take that as it is. This is an important one. Long-term investors, if you're in the market for the long term, you should not be making decisions based on one particular election. There are a number of factors that influence the markets as a whole. There are a number of factors that influence your decision-making. If you're having worries about the upcoming election and who's president and who's not, talk with us first. We're happy to have that conversation. We welcome it. We'll do it, try and be neutral with politics as best we can. And there are countless, like I say, there are countless forces out there influencing market performance. The election seems all-consuming right now, and it is for a lot of people, rightfully so. But as we look at the market, it's just one factor in a sea of many. All right, so that is all we had for the presentation. Kathy, I know you've been looking. Were there any questions? We'll open it up to questions now.
We did not have any that came in during the conversation. Does anybody have any now that they'd like to offer up? I am not seeing anything come in, Jared.
All right. Well, it was a pleasure talking with all of you guys, and thank you for joining us. For our latest thinking, be sure to check out the resources page on our website for the latest thinking, including new episodes of Bridging the Gap. Lisa and I record those weekly and try and get them up. It's a little tough with reopening the office to get them up weekly, but we're trying our best. So check out our website. The resources page is where those will be posted. All right, so thank you. Quick disclosure from the legal department, and that's it. All right, guys, thank you very much for joining us.